The markets are open, and one stock that does strike out is Adobe, one of the few that are in fact down in the market. Right now, negative 3%. In fact, it's down 27% over the last 12 months, and right now trades at its 52-week low. And as we will show you today, this is a company that looks very undervalued with some great upside over the next year at a bare minimum. Now, for those that don't know, Adobe itself developed creative software solutions such as Photoshop, Illustrator, Premiere Pro, for design, digital media, as well as marketing, and they also provide document management tools like Adobe Acrobat, as well as e-signature services through Adobe Sign. Now, in terms of looking at this company and the business model, what you will have noticed, not only has their revenue been increasing over the longer term, but actually the vast bulk of their top line revenue is made from subscriptions, and the other elements that we can see here pretty much not showing much growth. So the main driver behind this company is their large subscription base. Now, one of the reasons that we have seen this company actually have a very poor 2024, well, actually in their latest earnings, they had their largest drop over 2 years, and the main driver behind this was their disappointing revenue guidance. Now, what's quite interesting to note, when you actually look at the numbers they reported, something that we see on a regular basis with this company, they actually outperformed. They had 481 versus 466 market expectation, and as we can see, they did beat the analyst targets on the revenue. 5.54 expected, 5.61 was what was anticipated. Now, as we said, the main driver for this decrease, and one of the reasons why this company hasn't been doing good over late, is that their guidance is something the market is worried about. 5.73 was what they wanted to see for the next quarter, but actually they are anticipating a little bit lower, 5.63 to 5.68 billion. And we have one investment bank here that has lowered their price target to $600 from $650. Now, we're going to get into our own valuation, what we believe this company is actually worth intrinsically right now. But even at the $600 mark, this is looking like a great opportunity to consider in their portfolio. But we have noticed as of late a lot of bearish sentiment. Now, this isn't just due to the slowing revenue growth, but also rising competition in creative software, AI tools, as well as fears of overvaluation, something we do want to debunk today. But also macroeconomic factors for those that believe interest rates are going to stay higher for longer, and reduce corporate spending on software. These could always ultimately affect the company over the short and long term. Now, as we said, down 27% over the last year. Over the last 10 years, they have still outperformed the S&P, up nearly 500%. We've already mentioned trading right there at its 52-week low. We do get a double buy rating from both Wall Street and Seeking Alpha. And one thing to note, whilst they don't pay a dividend in this current period, this was actually historically a dividend paying company. Now, in terms of just their highlights from their latest earnings, well, look, their revenue is up 11% from the same quarter last year. We also notice the same increases, double digits, on the earnings per share on both a GAAP and non-GAAP basis, and their operating cash flows also up 83%. And we will look through the underlying metrics to question whether or not this is truly a growth company. And we can also see for the next full year, they are anticipating for 2025 around 23.3 to 23.55 billion, and this is ultimately around a 10% increase from last year. So again, double digit is still expected to continue, even though the market did want to see a little bit higher from the next quarter. In terms of their earnings over the long term, green right across the board, which we love to see. What this translates to, first thing, over the next 4 quarters, they are anticipating double-digit growth to the EPS on a year-on-year comparative, and they've also outperformed analyst targets over the last 4 quarters, beat after beat after beat, and essentially their next full accounting period, November 26, with their EPS estimate, the forward P sits around 19. Now, whether you use this one at 21.6 for November 2025 or 19 for 2026, this is still trading lower than the average of the S&P 500, and we'll also compare it to looking at the sector median comparative. Now, in terms of their underlying metrics, always very important to look at. The first metric is the free cash flow. What we want to see, consistent increases over the long term. We actually get a lot of growth, pretty much 7x from 2015 to 2023, although we do notice very minimal movement over the last full year. Nice to report though, over the next 12 months, a massive jump is expected to $20.60 per share. Then we talk about sales growth, where we were discussing the story around the growth. Now we do notice double digit every single year, and even over the last 3 years where it has started to slow down, we are still seeing around 10 to 12%, and as we just saw for their full year guidance for 2025, they do anticipate this to continue. And from a numerical perspective, just over the last 10 years, this company has quadrupled their top line, and one thing we do quite like, they haven't done a massive amount, but they've bought back around 10% of the shares from 2015, and as always, we do bring this to your attention as we like it when companies return excess cash through those share buybacks. In terms of ROIC, very promising, not only above the minimum 10% we want to see, but actually increasing over the period, 38% over the last full year. And remember, this is one of our favorite metrics, gives us faith management are able to effectively allocate their capital, so no worries whatsoever. Then we get to the margins, looking very promising on the operating front, not only above the 16% minimum, but we have operating efficiencies, 19% in 2015, 36 in the more recent period, and also free cash flow looking very strong on a consistent basis, definitely a historical free cash flow machine. Finally, net debt to EBITDA, one of our favorite metrics alongside ROIC. This tells us the number of years it would take the company to pay off all of their debt net of cash on hand and correlates to the balance sheet strength. What this tells us from 2020 and expected over the next 12 months, it won't even take this company one day to pay off all of their debt net of cash on hand, and we do believe so far these metrics are very, very promising. Now we also want to let you know we do release a free weekly article every single Monday morning where we highlight severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away, and you'll also be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can also grab a copy of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We then also want to look at insider ownership. Now this sits around 0.15% with around 40 million worth of sales over the last year. Now in the same time frame we do get a little bit of buying, but very trivial, so not much to discuss. And no buying or selling in Q1, you have to go back to Q4, although the large bulk of this 18 million was in Q3. And while we will show you for transparency the buys and sells, what we would point out here is that essentially insider selling isn't typically a bearish signal. They sell for many reasons, personal or financial. The most recent sale by the director on the 6th of December did net them around $333,000. As you can see here, information if you do want to incorporate it into your own investment thesis. Now, institutional aspect, 82% ownership, 12 billion worth of sales with around 19.5 over the same time period. So they have been buying more than they have been selling. Now, we don't have the full data set yet for Q4, but what we can see in the most recent data period of Q3 2024, there has been marginally more buying by the institutions than they have been selling. But as we already highlighted, over the last year, more buying. Now, regardless, insider, institution, buys or sells, always do your own due diligence and never copy what they do. Now, we've already highlighted their top line revenue, as we can see even just here on this graphical basis, very consistent increases over the long term, and as we mentioned, around a 4x over the last 10 years. Now, November 2025, they do expect, as we saw, around 23 to 24 billion, so that is a nice another double-digit increase to their top line expectation. And we also want to highlight their bottom line. Does it give us a similar story? And the answer is yes from the graphical perspective. 630 million reported in 2015, around 5.6 billion in the latest annual account. So very good sign, top line increasing as well as their bottom line, both moving in the right direction. Something you do expect, but not something we always see. And then we want to highlight the health of the company, total cash versus total debt. 4 billion in 2015, nearly doubled in the latest quarter at just under 8 billion. But as always, we never look at one number in isolation. We compare it numerically and directionally to their total debt. And what we do in fact see here is their debt has increased from around 2 billion in 2015 to 6 in their latest quarter, but they have a larger cash balance, nearly 8 billion, and as we said earlier, it wouldn't even take them one day to pay off all of their debt net of cash on hand. That is a very good sign. We also just want to flag the cash this company does generate from their operations, and as we can see, it has gone from around 1.5 billion to around 7.3, so it is very strong in aspect of this analysis. Now we're going to get to the gradings. The first one is the valuation. Now they get a D+, however, as we did mention, on a P non-GAAP basis, right now 21.58 if you do want to use the November 2025 figure. This shows us it is below the sector median at 25. So if you are buying this right now, you are in essence getting a 14% discount to the overall sector. Whether or not it deserves a discount, remember some companies actually deserve a premium, some are in line with the sector median, some we get the market overreaction, and what we in fact notice here, depending on which valuation metric you use, you will get a different conclusion, which is why we always run these towards the end into our own valuation process. Now the growth grade, they get a D+, however what we have noticed, double-digit increase to their top line, 11% versus the sector at 4.8%, revenue growth 10% versus the sector at 5.6%, and the one thing we like to draw your attention to, earnings per share over the next 3 to 5 years at 15%, pretty much in line with the sector comparative, so you could argue the D+ is a little bit harsh, and the same to be said for the valuation. Now profitability looking very strong, 89% gross margin with the sector at 51%, bottom line 26%, sector at 3.9%, and their cash from operations again with that A+, 6.73 billion with a sector comparative at 97 million. Now quick recap, we did get a double buy from Seeking Alpha and Wall Street. We got a D+ on valuation, D+ on growth with an A+ on profitability. Now two more things before we jump into the valuation process itself. Comparing their performance against others in the software industry, we have Intuit, Palantir, and many others that are very well known. And over the last year, down 26%. Remember, we did say pretty poor performance. They are in fact the worst out of some of these names. Over the last 5 years, when we expand, still, even though they're up, they are the worst performing. And over the last 10 years, up around 500%, putting them in the middle space. Now remember, whether or not you believe that is a good performance, past performance does not give us any indication on how they'll perform in the future. And we also want to do a similar comparative against the S&P. No surprises, over the last year they've underperformed. Over the last 5 years, again, underperformance. But when we zoom out, and as we said at the beginning of the episode, they have outperformed. Who knows what the future holds? The reason why we do this extra analysis, just to consider whether a low-cost ETF may be a better alternative or something to consider alongside. Now let's jump into the valuation, where our intrinsic value today arrives at $586, and we've got this using the DCF model. We have the free cash flow year on year. As we can see, the average growth rate at 23% over the last 10. Now we've gone for 12% moving forwards, although you will see here a low, medium, and high. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you will see, $586, indicating 37% upside. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Adobe or any others. But just for full transparency, at the 10% rate, it would be an intrinsically valued $509, giving 19% upside, and at the 14% for those that are more bullish, 674, indicating 57%. As always, we take the medium rate through, where we will apply our own margin of safety, and we always start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at $527, then we keep going till it's near the current trading price. And what we can see in today's episode, not at the 30% level just yet, but right now you are getting between 25 to 30 MOS. With Wall Street themselves are very bullish. We did get the buy rating. They have a price forecast of $604, indicating 41%. So right now, 25% MOS at a bare minimum, 41% upside. Is this one you are looking to consider to buy? Maybe it's on your watch list, or for whatever reason, if it doesn't fit your overall investment thesis, do give us your thoughts below. And as we said earlier, even the analysts themselves, whilst they are very bullish, they do have the buy rating, and they do like their strong AI integration and margin profile. Others have expressed some of their concerns about the delayed returns from the AI investments, the increased competition, but right now it is trading at its 52-week low. It does have a nice margin of safety, nice potential upside, so something to consider, but bear in mind revenue forecasts are lower than what the analysts wanted, whether or not that does affect your overall investment decision. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in at Patreon, where we do cover our weekly buys and sells, and as always, have a great day, and we'll see you all on the next one.